You've probably heard the argument. Boomers bought cheap houses, collected pensions, and left younger generations with the bill. Some of that anger reflects real inequality. Baby boomers hold just over half of U.S. household wealth, while households headed by people born in 1981 or later hold only around 1/10 combined. The post-2020 rise in home and stock prices disproportionately benefited households that already owned those assets. The frustration didn't come from nowhere. But beginning in the 1980s, policy advocates also promoted a very deliberate way of talking about Social Security, not as a dispute over taxes, benefits, and retirement insurance design, but as a conflict between young workers and greedy retirees. That framing has been promoted repeatedly through funded advocacy campaigns and policy organizations for more than 40 years. And financial firms have an obvious reason to prefer one particular conclusion from that generational grievance. Take retirement money out of Social Security and put it into privately managed accounts. Let's follow the money. The clearest written version of this strategy appeared in a 1983 Cato Journal paper by Stuart Butler and Peter Germanis, explicitly titled Achieving Social Security Reform, a Leninist Strategy. It argued that replacing Social Security required more than winning an economic debate. It required building financial industry support, reassuring current retirees to neutralize their political opposition, and cultivating constituencies that would favor private alternatives over the existing program. The paper was explicit about the strategic value of generational framing, positioning younger workers as the natural opponents of a system that benefited older ones. Peter G. Peterson did not write that paper, but his later advocacy operated in the same broader policy movement. Peterson co-founded Blackstone, one of the world's largest private equity firms. He committed $1 billion to establish the Peter G. Peterson Foundation in 2008, dedicated to addressing what he called America's long-term fiscal challenges. Over subsequent years, the foundation funded a wide range of research, advocacy, public awareness campaigns, and policy organizations focused on federal debt and entitlement reform. Critics interpreted Peterson's work far more harshly. Economist Dean Baker described it as a campaign to gut Social Security and Medicare. William Greeter argued in The Nation that the language of fiscal responsibility concealed an attempt to weaken the programs. The Peterson Foundation presented its mission differently, as protecting the programs by addressing their long-term fiscal shortfalls. What is documented is that nearly $500 million flowed through Peterson-connected advocacy into Washington over the years following the foundation's establishment, consistently emphasizing the framing of entitlement spending as a burden on younger generations. Now here's why this framing is so strategically useful. Social Security is extraordinarily popular. Polling consistently shows support above 80% across all age groups, including among younger workers who are decades away from collecting benefits. A direct campaign saying, "Let's privatize Social Security so financial firms can collect management fees," would be politically impossible. But a campaign that says, "The current system is generationally unfair, younger workers are subsidizing retirees," changes the emotional question entirely. It transforms a policy debate about program design into a personal grievance about theft. And if younger workers can be convinced that Social Security is fundamentally illegitimate, a transfer from the productive young to the consuming old, then redirecting payroll taxes into privately managed individual accounts becomes dramatically easier to sell. Not as a gift to Wall Street, as justice for young people. So what is the actual financial opportunity? Social Security currently paid benefits to roughly 70 million people at the end of 2025, while approximately 186 million people are expected to work in covered employment in 2026. The program's administrative costs are well below 1% of total program spending, among the most efficiently administered large-scale financial operations in the world. Private accounts would involve different services than Social Security currently provides: custody, trading, record-keeping, and investment management. So the comparison is not perfectly equivalent. But even small recurring asset management fees, applied to trillions of dollars, create a substantial revenue stream. Here's the math, presented as scenarios rather than guarantees, because the outcome would depend entirely on how Congress designed the accounts. If private managers controlled $1 trillion in redirected Social Security assets and charged an average annual fee of 0.25%, the annual fee pool would be approximately $2.5 billion. At 0.5%, it becomes $5 billion per year. At 1%, closer to what retail actively managed mutual funds have historically charged, it becomes $10 billion per year. On $2 trillion in assets at 0.5%, that's $10 billion annually. These are not projections of what would happen. They are illustrations of the scale of what's at stake in program design decisions that sound technical but are financially enormous. During an earlier privatization debate, the Securities Industry Association estimated that a low-cost, tightly constrained system could generate tens of billions of dollars in fees in present value terms over 75 years, while a more complex retail-style system could generate hundreds of billions. Those estimates are dated and depend heavily on program design, but they demonstrate why the financial industry has an economic interest in how private accounts would be structured, not merely whether they exist. And compounding fees matter enormously at the individual level. With the same gross investment return, an additional annual fee of close to 1 percentage point can reduce a 40-year ending balance by roughly 20% or more, depending on contribution timing and return assumptions. That's not a rounding error. That's the difference between a comfortable retirement and a strained one, extracted not through poor investment performance, but through the cost of managing the account. Now, here's why 2026 makes this more urgent than it has been in decades. The 2026 Social Security Trustees Report projects that the Retirement and Survivors Fund, OASI, will deplete in late 2032, after which its continuing income would cover approximately 78% of scheduled retirement and survivor benefits. On a combined illustrative basis with the Disability Fund, reserves would deplete in 2034, with continuing revenue covering about 83% of combined scheduled benefits. Under current law, however, the two trust funds cannot automatically transfer reserves between one another, so the retirement fund's projected 2032 date is the more immediate pressure point. Senators elected in the 2026 election cycle will serve through the period when the retirement fund is projected to approach depletion, making Social Security reform increasingly difficult to avoid politically. That creates the policy window this argument has been building toward for 40 years. The program is not going bankrupt in any conventional sense. Social Security would still collect payroll taxes and continue paying benefits, just at a reduced level without congressional action. The options for addressing the gap are known and multiple. Raise the payroll tax rate, lift the cap on taxable earnings, currently $184,500 in 2026, meaning income above that threshold is exempt from Social Security payroll tax, increase the retirement age, reduce benefits, add general revenue, or some combination. None of these options requires privatization. Privatization is one possible response to a financing gap, and it is the response that creates the clearest potential new revenue stream for private asset managers. The generational framing is useful to that particular response specifically because it changes the political question. Instead of, how should we close a revenue gap in a social insurance program, the question becomes, why should young workers fund a broken system that took their money and gave it to retirees? The first question has multiple answers with different distributional consequences. The second question points toward one obvious conclusion. Boomers didn't design Social Security's payroll tax structure. They didn't set the taxable earnings cap at a level that exempts high earners. They didn't make the decision not to pre-fund the system adequately for demographic shifts. They are collecting from a program they paid into for 40 years, at benefit levels set by Congress, administered by a federal agency. The individual boomer your coworker resents is not the entity that benefits from Social Security privatization. The entities that benefit are the financial firms that would collect management fees on retirement assets that are currently administered at a cost well below 1% of program spending. The Social Security shortfall is real. The generational wealth divide is real, but neither proves that young and old Americans are natural enemies. The real policy conflict is not simply young versus old. It is about how much retirement risk should be pooled through social insurance, how much should be borne through individual investment accounts, how transition costs would be financed, and who would collect fees for managing the money. Private equity does not need you to hate every boomer. It needs generational resentment to make the current system feel so illegitimate that transferring part of it to privately managed accounts begins to look like justice.